Welcome back. Today we are going to explore a decision that might seem small at first glance, but in reality, it has the power to fundamentally transform your financial future. It's a decision so simple that it can be executed with just the click of a button, yet it can result in hundreds of thousands of dollars in either gains or lost potential. The question is this: should you allow your dividends to automatically reinvest into your portfolio? Or should you attempt to manually time the market, reinvesting only when conditions seem perfect? While it may appear trivial, the numbers paint a clear and compelling picture. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Consider this scenario. You invest $10,000 upfront and contribute $100 every month. If you choose automatic dividend reinvestment, after 20 years, your portfolio could grow to approximately $240,000. If you opt to let dividends accumulate as cash and manually reinvest, the portfolio might only reach around $132,000. That is a staggering difference of over $107,000, simply from deciding how dividends are handled. Some investors argue that manual reinvestment can slightly outperform automatic reinvestment if executed perfectly, perhaps by an additional 0.5% to 1% annually over 20 years. However, the reality is harsh. Approximately 95% of investors who attempt manual reinvestment fail to consistently deploy dividends on schedule. Instead, dividends sit idle, waiting for the so-called perfect opportunity to buy more shares, a moment that often never comes. Market opportunities pass, 5% gains, 8% gains, and sometimes sudden jumps of 15%, yet the capital remains uninvested, earning nothing. Take SCHD as an example, a popular dividend-focused ETF. Over the past decade, its dividends have grown at an average annual rate exceeding 11%. By leaving your cash uninvested, you are effectively sidelining a powerful compounding engine that could work for you quietly, quarter after quarter. Manual reinvestment only truly works if executed with perfect discipline, such as deploying cash within a week of a 3% drop every single time, a standard that most investors simply cannot maintain. Therefore, for the majority of investors, automatic reinvestment is the clear winner. The next layer of strategic thinking involves combining dividend-focused funds like SCHD with growth-oriented investments such as VIG, VTI, or SCHG. Your age and stage of life play a pivotal role in determining the ideal allocation. For investors under 40, a practical strategy could be 50% in growth funds, such as VGT or SCHG, 30% in SCHD, and 20% in bonds or short-term treasury bills. This allocation allows you to participate in technology and growth-driven appreciation while simultaneously establishing a reliable income foundation. Bonds or treasury bills in this allocation act as dry powder, ready to be deployed opportunistically during market corrections. For investors between the ages of 50 and 55, it makes sense to gradually shift the portfolio to roughly 60% SCHD, 20% growth, and 20% bonds, emphasizing income generation and capital preservation while still retaining some upside exposure. Investors over 55 should consider 70% SCHD, 10% growth, and 20% in bonds or cash reserves, focusing primarily on generating consistent income and protecting accumulated wealth. Another compelling strategy, regardless of age, is a combination of SCHD and VIG. Here, SCHD provides an immediate income stream, yielding roughly 3.77%, while VIG consists of companies with a long history of consistent dividend growth. By combining these two funds, investors capture both current income and future income growth, creating a portfolio that can weather market fluctuations while steadily compounding wealth over time. For those seeking even broader diversification, one could consider an allocation such as 30% SCHD, 40% VTI, 20% international equities like SCHF, and 10% flexible cash or short-term bond reserves. This diversified approach spreads exposure across domestic and international markets, growth and value sectors, without excessive concentration in any single asset class, mitigating risk while maintaining long-term growth potential. Tax efficiency is another often overlooked factor that can dramatically impact wealth accumulation over decades. SCHD dividends qualify as qualified dividends, meaning they are taxed at 0%, 15%, or 20%, depending on income brackets, rather than the higher ordinary income tax rates of 22 to 37%. This difference is significant. High earners, for example, may pay 37% on bond interest income, but only 20% on SCHD distributions. Over long periods, the compounding effect of paying lower taxes can result in substantial additional wealth. The optimal sequence for tax efficiency is to first maximize contributions to a Roth IRA, allowing SCHD to grow completely tax-free. After retirement account limits are met, excess funds can be directed to taxable accounts. Even though taxable accounts trigger quarterly dividend taxation, the qualified dividend rates of 15 to 20% still outperform nearly all alternative income-generating strategies. SCHD's expense ratio is extremely low, roughly $6 per $10,000 invested, and its low turnover minimizes taxable events. For cash reserves, short-term Treasury ETFs such as SGOV or T-BYL offer yields around 4.5 to 5% with negligible interest rate risk. Traditional bond funds, in contrast, can lose value as interest rates rise, whereas Treasury bill ETFs maintain stability and preserve capital. Time horizon is a critical component in dividend-focused strategies. SCHD and similar funds are not designed for short-term investing because they can experience 20 to 30% declines during market corrections. To fully benefit from compounding, investors should ideally have a horizon of at least 10 years. If you anticipate needing the money within 5 years, funds should be allocated to high-yield savings accounts, CDs, or Treasury bill ETFs like SGOV to protect against near-term equity volatility. Historically, SCHD's 10-year compound annual growth rate is approximately 12%, reflecting resilience through multiple market downturns, including the COVID-19 crash. Diversification is another advantage that often goes unnoticed. Unlike the S&P 500, where 7 companies now control 35% of the index, SCHD's top 10 holdings account for only 42%, spanning multiple sectors including healthcare, consumer goods, industrials, and energy. Key holdings include Amgen at 4.8%, AbbVie at 4.5%, Cisco at 4.4%, Merck at 4.4%, and Coca-Cola at 4.2%. This spread ensures that no single company dominates your returns, significantly reducing concentration risk. Annual rebalancing keeps positions in check, automatically rotating out holdings that are overvalued or whose fundamentals weaken, thereby removing emotional bias from investment decisions. Current market conditions further highlight the opportunity for dividend-focused strategies. Recently, the markets delivered back-to-back annual returns exceeding 20%, a scenario that has occurred only a handful of times since 1871. At the same time, concentration in the S&P 500 is at all-time highs, with the top 8 companies controlling 36% of the index. By comparison, SCHD trades at approximately 16 times earnings, significantly lower than the S&P 500's 27 to 29 times earnings, and simultaneously provides a 3.77% quarterly dividend. This stark contrast emphasizes the choice investors face. Either collect dividends from reasonably valued, diversified companies, or chase overvalued growth stocks with heightened risk. Allocation strategies should reflect age and risk tolerance. Investors under 40 could consider 50% growth, 30% SCHD, 20% cash bonds, while those aged 40-55 may shift to 60%. SCHD 20% growth, 20% bonds, and investors over 55 should prioritize 70%. SCHD 10% growth, 20% cash or bonds. Automatic dividend reinvestment should generally be used, except for the rare investor who can act unemotionally and with perfect discipline. In summary, automatic dividend reinvestment provides the most reliable path to long-term compounding for the majority of investors. Combining SCHD with growth funds creates a balanced, age-appropriate portfolio that maximizes both income and appreciation. Tax efficiency, time horizon, and diversification are critical components that can dramatically impact long-term outcomes. By prioritizing Roth IRA contributions, utilizing Treasury bill ETFs for cash reserves, and staying invested over a decade or more, investors position themselves to capitalize on compounding while minimizing risk. Ultimately, the choices made today will determine whether, 10 years from now, You are celebrating a disciplined, well-executed investment strategy or regretting missed opportunities. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.